So I'm going to skip over the DCM overview and jump right into the state of the venture industry. And one of my key messages that I hope to convey here is the fourth bullet point here, which is some reasons for optimism. I'll probably spend 5 minutes going through those. And I think now is an excellent time for people that are interested in venture to begin to take an analytic and an objective view about opportunities that are out there. And I think if we look back in history, we will see that if you are a believer in the cyclicality of our industry, if you believe that innovation is still alive and well, you'll conclude that now should be a pretty good time for investing in this asset class, as long as you pick the right managers. Our firm has just been active, as Alexandra mentioned, in the US, China, and Japan. We call this our Golden Triangle strategy, and we've raised 6 funds and are actively trying to take advantage of all the synergies and knowledge arbitrage that can be created by working with companies that leverage these different geographies, which are all very important in the internet world, the mobile world, and e-commerce, et cetera. So, state of the VC industry. Right now, the economic instability from the volatile markets here has certainly impacted venture industry's ability to get liquid. And we're seeing signs of thawing in the IPO market, which has been basically closed for the last couple of years. But we're not anywhere near where we need to be now. We had an average of 150 IPOs of venture-backed companies throughout the better part of the 90s. And we did actually happen to have 9 get out in the first quarter, so on an annualized basis, that would suggest something like 35 or 40. But the volatility in Q2 has definitely impacted that, so it's anybody's guess. But I'm still sticking by my projection of 40 to 50 venture-backed IPOs. M&A has picked up very sharply. I'll show you a bunch of charts in here in a minute, but I think we're making good progress, better progress in the M&A front, but we would still like to see a lot more balance between IPOs and M&A. There are plenty of opportunities out there today, and I'll go through some of these at a high level as we go to the later portions of this presentation here. So what I always like to do is to just keep everything in perspective here is that many of you already know this, but for some of you that are new, our industry is, is famous for many things, but one of the things that's consistently true about our industry is its cyclicality. And we always have these periods when, irrational exuberance gives way to extreme pessimism. Many people are down on the venture industry because of the poor performance throughout the first decade of this century. And I think that, there are some reasons to be optimistic, and I'll come back to those a little bit later on, but we were beginning to come out of the traditional cycle in the year 2007 when the external events that we all know about now interrupted the recovery and basically set us back to square one. But in the last couple of years, once we got through the period of extreme market volatility, we see signs of improvement in the venture industry, and let's just hope that we can keep that progress up. So some of the statistics here, the actual dollars of investment have declined from the peak of around 30 billion a year in 07 in the recent period down to an annualized rate in the middle teens, if you look at what is projected for 2010 here now. New VC fund commitments are way down. This is providing less competition, which means that the firms that are in business going forward are going to have a more favorable environment in which to evaluate deals and price a more favorable pricing environment, all of which should lead to improved returns that I suggested before. Talked about the IPOs here. The number on the right-hand side here is 9 so far this year, so my projection is 40 to 50, and it's good, but it's only good in a relative sense. It's nowhere near where it needs to be. M&A data here shows the extreme rebound of that activity out there on the right-hand bar chart. And we all know that the big technology acquirers are flush with cash. They have more cash on their balance sheets now than they have ever had at any point in time. And we've been seeing a really significant acceleration in the pace of M&A. A lot of really good transactions have been happening recently. I'm not going to do the carry tax. Mark did that very eloquently, and I'll just jump through this. We've all made the point here that the impacts of these proposals are reduced U.S. entrepreneurial and international competitiveness here, a higher bar for U.S. startups, and an acceleration of domestic VC consolidation, which has both pluses and minuses. Another important point that needs to be looked at carefully by, especially by legislators, is what's happening in the exit market. It's actually pretty shocking if you sit down and go read any recent reports like the one by Ernst & Young, some of the stuff that comes out of the NVCA. Just go Google up, international liquidity, and you find a staggering amount of activity happening in the capital markets outside the U.S. And this is, it's really, really shocking. And in China right now, there are 2 new exchanges that are just beginning to come into existence. There's the Chinex market, which has approximately 50 companies listed on it so far. There's the A-shares market, and I've seen some of the actual valuation data on these companies. It's significantly higher, and the multiples that are associated with exits on these exchanges like Chinex are significantly higher than those in the U.S. I don't want to suggest for a moment that the Chinex market is completely a liquid market yet, because it really isn't. The government turns it on and turns it off depending on the volatility. But you can be sure that 5 years from now, a lot of the activity for exits of our portfolio companies that have any access at all to the IPO windows in China, a lot of that activity is going to shift away from the NASDAQ and the New York Stock Exchange. And it's actually, it's a big warning sign, and that's another really important reason that we don't need to kill the goose that laid the golden egg here. We need exits. We need to have that liquidity available in the U.S. In the short term, NASDAQ and New York Stock Exchange are still preferred vehicles for internationally minded companies outside the U.S., but that's not going to hold true for more than a few more years, given the trends that we see on the horizon now.